What's going on, guys? It's GBP baby. Welcome back to another video. I hope everybody's doing well, and today we're going to be looking at IPDA data ranges. Now, I understand ICT has 2 episodes on IPDA data ranges, one of which is 2 hours long and another one I think is about 30 minutes. So yes, it is a lot of time. It is very time consuming if you want to go and learn it yourself. I do still suggest and encourage you to go learn it yourself, but I'm just going to go through what I know and my understanding of it. So we're going to be using it on DXY this time around, and we're going to be casting back the previous 60 days, and we're going to be casting forward the 60 days. So one thing you need to take note of is that with the IPDA data ranges, price uses these ranges in order to refer to certain price levels and for us to help get a it helps add confluence to our bias. So IPDA will run on a 60, 20 and 40 day basis, meaning that it will refer to highs and lows or swing points within those ranges, which is why we're going to be casting back 60 days and also casting forward 60 days. One thing that ICT also states is that you need to start your cast back from the previous month, meaning that we're not going to, for example, it's February right now. I'm not going to cast back 60 days from the 1st of February. I'll cast back 60 days from the 1st of January. That's what we're going to be doing. And then from then on, you can also calibrate it so that it adjusts to major turns in the market as well. But let's get straight into it. So I'm going to use a simple vertical line to do this. We're going to find the first trading day of January, because remember, we're in February now, so we're going to be looking at the previous month's first day, which is here. I'm going to make it a little bit thicker, and then with my measuring tool, I'll simply go back 60 bars, which is right here. And as you can see, it says 60 bars. Now, it does say 88 days, but I don't look at the days, I look at the bars, because the bars are the trading days. So we don't want to be including, for example, Sundays or holidays. So I ignore the 88 days and I look at the 60 days, 60 bars instead, at least, because then I know it's 60 trading days back. I'll then paste another line there. And then I'm also going to cast back 40 days. So we get 40 bars right here. And then we're going to cast back 20 days from here as well, which takes us right here. And then with regards to casting forward, we're going to do the same thing. And then once we've done this, we need to take into consideration that every 3 months, the market goes through a significant change. Now, we can see a significant turning point right here, which happened as we started the month of January, which is quite interesting. But generally speaking, 60 days ago was about 3 months ago, so we anticipate some kind of major turn to happen, and that's what we saw happen here. So you can already see how this data range is going to help us to frame. Right, so as you can see, we've got 20-day look back, 40-day look back, 60-day look back, 60-day cast forward, 40-day cast forward, and 20-day cast forward. Now what we're going to do is we're going to be marking out and delineating the highs and lows of each range. So for the 60-day range, we're going to mark out the highs. So the highest high, which is here, and I'm going to make that red. Actually, we'll make it blue. And then we want to mark out the lowest low of the range as well, which is here, and we'll make that red. So all the highs I'm going to make blue, and all the lows I'm going to make red. So now I'm going to do the same thing for the high and low of each range. So the high of this period is from here right through to here. Now we did open and drop, but I'm going to be using this swing high since it's a significant swing high. And then we want to mark out the lows as well. So you can see that this low has been traded through. And what I'm going to do is I'm going to make it dash from the point that it's been traded through, just so that we can study it. So what PD arrays can we see on our 20, 40 and 60-day look back period that we can apply to our charts? Well, we have this massive imbalance, daily imbalance, that we've slightly traded into already, that I do believe price is going to continue to draw into. So there's this fair value gap, and what price will do is it will seek to trade inside of it. So, and then what we can also do is we can look at the midpoints of these ranges in order to help find levels of support. For example, if we look at the midpoint of this range, so from this high to this low, you'll see how again price consolidated at that midpoint of that range. So we can also look at this range, high to low, and you can see how price again is pretty much in a consolidation currently. But because we're bullish, we should be looking for bullish PD arrays. Obviously, we have this swing high up here and a volume imbalance just above here. But right now, this daily fair value gap is where we should be looking to trade to. Now, similarly to how we found support at this low, we should be looking at this swing high as a level for us to be finding support. And you can see how price right now is just pushing on this fair value gap that is leveled with this. So if you've been watching my reviews recently, you'll know that I've been calling this level out a lot, saying that I want to see price trade into it, and we haven't traded into it just yet, and we very may well tomorrow. But what I'm saying is that this is the swing high from the previous range, and we can use that as support for our bullish ideas, as in, yes, price may trade into it, but we have this assurance almost that price is likely going to trade away from it and use it as a support level. Why? Because we traded aggressively through it. We've taken out 2 sets of swing highs. We're in a bullish program because we had our major turn that I was talking about, and we have this daily fair value gap up here. So what the IPDA data range is allowing us to do is, again, frame an idea for where price is drawing to and where the draw on liquidity actually is. So now we can go down to the 4 hour and take a look at price. So you'll see again the daily divided, the IPDA data range split as we did it on the higher time frame, but now this is the 4 hour chart, and simply the same. We can just look for areas at where price is likely to draw to. So we took out this high, consolidated, traded aggressively higher. Again, look at where we're consolidating and how we traded through this level. When price comes back down here, we expect to find support. Why? Because we're expecting this fair value gap and this massive imbalance to start getting filled. Now again, we do have a swing high up here, and we do have a liquidity void resting just above it that price may want to trade into. Now it doesn't have to reach up here, but we should definitely keep our attention set on this. So that's going to be up there. We can look at the range of this 20-day cast forward, and you can see the midpoint. Again, look at how price found support on this level, and then we came back down to it once, twice, and then traded aggressively higher. So price is referring to these levels, and by casting them down to lower time frames, it really helps us navigate the markets at a much smoother way. So again, we can go down to the 1 hour. Again, you can see that level marked out in orange that I was talking about, that price is likely going to want to draw to. But overall, I'm looking for this massive daily imbalance to be getting filled. So once it does fill this, we are going to be coming up to this 3rd month, right? So we're going to be coming up to that 60-day period. So what can we expect? Well, once we get to the end of February, we can start looking and anticipating some kind of big turn in the market, just like we saw happening after this 3-month period, just like we saw happening over here. So once we get to the end of February, I'll be looking at this IPDA data range again, saying, okay, is price going to trade up into this real liquidity void, or are we going to turn around after taking out this high? And that's assuming we even get to that high. If price fails to get to that high and we start to see a break in market structure, we can think, okay, that means price, we can start anticipating lower pricing and start looking for the lows. And where are the lows? Here, here, and here to be targeted. Just like when we reversed here, we'll be looking at the highs here, here, and here. So the IPDA data ranges really help stage and create navigation in the markets. So now we're going to do the same thing just on pound this time. So what do? We go to the previous first day, which would be the first trading day of January. So we have, which is right here, and then we want to cast back how many days? We should know this now, 60 days. So we go down 60 bars. And then now what do? We mark out the highest high and the lowest low of this range. So this is the lowest low. And then we want the highest high as well, which we'll make blue. And we also want to make that thick as well. And then we want to also get each individual day. We're looking now for this low to get targeted. And then we've also got a fair value gap down here. So again, we're doing the same thing. We're looking for, okay, if we're bearish, we've taken out a significant swing low. Why? Because this was the low from the previous 20 days. Like, this is a significant swing low that we've taken out here. So we're anticipating this low to now be the next target. Once we trade through that low, we also have a fair value gap down here at a high. So we may find support at this fair value gap. So we can drag that out as a potential draw on liquidity, and we can write a fair value gap. The fact that we close below this low is very bearish behavior. So now we can drop down to the 4 hour and see how price translates. There you go. You have the IPDA data ranges right there. And you can see we're kind of struggling to get down there, but I am anticipating large expansion to the downside. Like, we should push through aggressively. What we can also do is we can look at the range that we're currently trading in. So we can go from this low right up to this high. and you can see where the 50% level is, and you'll see that this is in a discount. And what does the market do? The market moves from premium to discount and vice versa. So let's just make this a little bit more clear, and you'll see that we're just consolidating at that 25% level. So again, we anticipate price in our target, the discount, which is down here. So this is our next drawn liquidity, this daily fair value gap. I have a swing low there, so now we should be, so what should we be doing? Generally we should be looking for shorts because we are in a sell program. Again, 3 months here, we had a change in market, shift in market structure. We moved higher, 1, 2, 3, and then what are we witnessing right now? Another shift in market structure. So we're bearish again. But when you drop down to the hourly and you have these markings out, it really does help navigate, and you know, it reminds you, okay, we're bearish, we should be looking for shorts. And then looking at news releases as well to help us frame those shorts and where to expect them. So yeah, that's going to be everything on pound. Now let's do the same thing on euro. I do think we may just be able to copy and paste this right over. Let's see if this is possible. So here we are on euro, and we're going to do the same thing. And first, let's take a look. What happened 3 months ago? We had a reversal and we started to trade higher. And then what's happened again? We hit this point and now we're starting to trade lower. So you can see every 3 months there is a significant shift in the market. Now don't get me wrong, there can be continuations. For example, here this is longer than just 60 days. So there is possibility for continuation depending on market conditions, but generally speaking, we anticipate some kind of shift or continuation. And I'll show you what I mean by that. If we drag these over to about there, you can see that this is 1, 2, 3, 4, 5. Like this is over 60 days basically, but you can see that there's a clear continuation. So that is still a possibility when we get to those points, but obviously once we look at the higher time frames, so maybe the yearly or the 3 months or the monthly, that's when you can start to frame whether the price is likely to continue lower or we're going to witness a reversal. And as you can see, we've seen a nice reversal. So what are we looking for? Again, we're going to mark out the lowest low, and then we're going to mark out the highest high. We do have another low right here of this range, and you can see we're just touching that, but I'm anticipating price to trade through it. Now the thing is, if price does trade through it, the next low is down here, so we should be looking for PDA raise in this range, but we'll get to that once we've done the highs. So let's get the highs marked out. So this was the highest high that got taken out instantly. And then we can also look at premium to discount, so discount to premium. Again, we've traded through that 50% level, and you can see that 25%, 75% level price going to want to seek that. And then we also have a nice daily fair value gap down here that price may want to trade into. So this is the only PDA rate I can see price drawing to on euro, which is quite deep into the discount, showing that euro is quite weak. But let's drop down to the 4 hour and see how price is acting. So you guys can go in your charts and do the same thing, you know, very important. Let's go down to the 4 hour, and then you can see how price, look at that. Look how price is treating these levels, trading higher into a little premium. And remember, next week we do have CPI and things, and I do believe that's going to help push and run price lower. Relative equal lows down here, and that daily fair value gap. Price could go for the lowest low, that's fine if it does, but generally speaking, I'm looking at this daily fair value gap as euros draw. And yeah, you can see how price is creating these levels, and again referring to them. There's been a lot of consolidation, not the best price action at all. So I hope you found this insightful. I hope you now know how to do IPDA data ranges. If you have any questions, honestly, drop a comment, I'll reply to them. And yeah, I'll catch you in the next one, guys. Peace.